Hi everyone, it's Ari here. I am going to talk today about a company called Intrepid Potash. This is a company that produces potash, which is important for fertilizers used in agriculture to enrich the soils and increase crop yields per acre, or the amount of corn or soybeans that can be grown on a specific acre. Now, Intrepid Potash is the largest, from what I understand, potash producer in the United States. In general, the industry is quite concentrated. The other major potash producers are in Canada and Russia and some in Europe and in China. But in general, there's only a few, maybe I think 5 big players in this industry. Intrepid is actually quite small, maybe producing 1% of the market volume of potash, but they have a strategic advantage in that they're located within the United States, which generally has better institutions and is also closer to a lot of the customers, which are farmers, and therefore they can deliver product more timely and also more reliably, so that they can charge a slight premium over the prices that the international potash producers can charge. So uh, the potash industry has been getting some negative reviews for the last couple of years. Actually, you can see the chart for this company as I zoom out. They went public in 2008, and that happened to also be a time when potash prices were quite high, the highest they've been in the last decade. And then ever since then, there's been somewhat of a decline in potash prices, and therefore the value of the shares of Intrepid Potash. These guys own mines that have the material for producing potash, and when the price of potash goes down, then the value of all of the assets or the mines goes down too, because you can't sell your mined product for as much. Now, a couple of reasons for why the price is declining. One is that there was oversupply. So whenever you have years of high potash prices, you generally have large capital expenditures or investments in bringing on more supply to meet the high demand. That generally, if there's lack of coordination amongst the suppliers, you tend to see overshooting, and there's too much capacity in the market relative to demand. This was somewhat exacerbated in 2013 when the Russian player, the major player in Russia, lost its ability to control the market or regulate supply. They were broken up and with an antitrust play, and that reduced some of the ability of these major players to control price. So you're, in some sense, you're a little bit seeing like what happened to oil and OPEC. You're seeing some competition on price in a way that aims to get rid of the high cost producers of potash and win market share. But and so, as you can see, in the since 2015, and 2015 June of last year, we were around $12, and now we're at $1.45. So we're deep in penny stock territory, and there's plenty of reasons for why we're this low. Now, I'm going to make a case for perhaps a bullish opportunity here, or there's an opportunity to make money by going long. And I'll give a couple of reasons for this. First of all, whenever I look at a company and I want to make a bullish case, I always want to see whether the management already share my opinion or not. And I like to use this website called Open Insider. And what this shows is the latest insider transactions by staff and the company. So in this case, you can see that Robert, so here I entered in the ticker symbol here and looked up Intrepid Potash. You can see that Robert, who's the chairman, president, and CEO, he's also a 10% shareholder, he's been purchasing. And so his first purchase showing up here was September 21st, 22nd, and 23rd. So on 3 consecutive days, he made purchases. And here you can, in this column, you can see the value that was traded. He bought about 900,000 worth of the stock. Then on the beginning of November, he purchased another 600,000 of stock. And then recently on March and on May 11th, he purchased another $900,000 of stock together. And you can see he started purchasing at 7, then 6, then 4, then $1 range. And this is meaningful in one sense, in that this CEO and chairman thinks that the price is a good deal, otherwise he wouldn't necessarily buy it. On the other hand, he's quite wealthy, so at the time of the IPO, he and Harvey, this guy here, were the founders and held a lot of the company and made $400-something million from the IPO. Of course, a lot of this, he retained a lot of this value in stock. And so if we look at, he had around June of last year, when the stock was at 10, he had about 11 million shares, say, which means he had $110 million worth of the stock. Now that the stock's down at $1, say, he has $11 million worth of stock. So he's looking at almost $100 million loss of wealth. Nevertheless, he still found it in him to reach into his pockets and put more money into the company. So despite having lost $100 million, he still, on paper at least, he still thinks that the company is worth more. And he started thinking that at 7, 6, 4, and now 1. So I like this because you want to have, first, you want the CEO to have a large upside position in this company, because then they're going to usually act in the best interest of the shareholders. So he has about 15% of the company right now, and in total the management own about 30% of the company. So their incentives are aligned with shareholders, and they're going to try to maximize shareholder value. Also, what I like is that he's been buying on the way down, which suggests that despite the stock falling and becoming more risky, the chairman and CEO doesn't think that an event like a default or a shareholder wipeout is very likely. In fact, he thinks that the stock is attractively priced, and that's why he decided to buy. And we'll look at that in 1 second. So it's nice that the insiders who have been with this company for years and know this industry better than I could ever know are voting for this company despite the stock price having gone down so low. Now, let's look quickly at the financials. So on Google Finance, which is public to everyone, you can click on Financials. And the first thing it's going to show you is the income statement. And good golly, look, you can see in fourth quarter of 2015, you can see net income was hugely negative. And so if we go, fourth quarter was this quarter, you can go down, you can see 518 loss to shareholders, or a loss of about $6.85 per share. Why was that? Well, it's all due to, does it show up here? It doesn't show up here. Unusual expense. So they had an unusual expense of $323 million that quarter, which was a write-down of their assets. So whenever the output from a mine, in this case our potash mines, decreases in price, so when potash prices go down, the expected cash flows for the mine go down too. And if the expected cash flows that the mine's going to receive in the future go down far enough, then the company is required to write down the assets and test. So they test for an impairment of asset value, and then they write down the assets. And that's what they chose to do in this quarter, and that's because the potash market seemed to weaken and prospects seem to remain weak. Now, the income statement is interesting, but when you have a company that's in distress, you probably want to look more at their balance sheet and their cash flow statements. So let's switch to the balance sheet. You can see for the balance sheet that in the first quarter and in the fourth quarter, so you can see the write-down happen. So the value of their assets is the blue bar, and in the fourth quarter they wrote down their assets. And as a consequence, the total debt, or the face value of the debt to asset ratio, went up from, say, 10% to now 25% on a book value basis. So on a book value basis, they have a leverage of about 25%, or the debt to total assets is about 25%. Well, we can see that here. So you can see what kind of debt they have. They have 150 million of debt. Turns out that it's unsecured debt, which means that it's not collateralized by any specific property in the company, but it does have a priority claim versus the common stock shareholders. So they have 149 million of debt, and then if we look at the asset side, you can see that they have the value of their plants and their mines is about 520 million, but it's been depreciated over time, so it's worth about 410 million. So relative to the value of our debt, our assets, our loan, are worth substantially more than our debt. And we also have cash. We have $55 million of cash. So usually when we talk about debt, we talk about net debt. So we take the total debt, total long-term debt, and we subtract the cash, and that gives us our net debt, which in this case is 150 minus something like 50, or $100 million. This company, so usually when you do net debt, you subtract excess cash. So it's total debt minus excess cash. Here we don't have an estimate of excess cash, but probably short-term investments are excess cash, and this company generally can cover most of their funding from cash flows from operations, so most of this is probably excess cash. But for sure, the short-term investments is excess cash because they're not holding it in cash; they're choosing to hold it in investments. So if you take off 30, then you have 120 million of debt. And if we go back to the market, we can see that they have about 120 million equity value. So their market value leverage, which is the market value of their debt, which we assume is face value, we assume that was 149 less the excess cash, which is 30, which is 120, divided by 120 plus the market value, which is also 120, you're going to get about 50% market leverage. So they have 25% book leverage and 50% market leverage. Now, and so evaluating this, it seems fairly unleveraged, which is nice. 50% is on the higher side, but 75% market leverage is really when you start to see problems and when default and maybe shareholder wipeout are more likely. So at 50% leverage, we're leveraged, but we have a company with a lot of hard assets. They have all these mines, and they produce a valuable product. They'll be valuable for as far as we can see. Nitrogen is necessary to add to soils to increase crop yields. So they have a lot of hard assets, and they have some debt, but the debt is not so large relative to their assets. So also notice they don't have any goodwill, and they don't have any intangibles. So these are things like brand value or soft value, things that are not hard assets. And because we don't have any of these, when we look at the difference between our assets, which is our total assets of 630 million, and our total liabilities of $220 million, we get an equity value on a book value basis of $410 million, and this is what's called tangible book value because it includes only tangible assets, or we're excluding goodwill and we're excluding intangibles. So 409 book value of equity, okay, and it says they have 76 million shares. So if we calculate 410 divided by 76 in Google, we can see that the value per share on a book value basis is about $5.40. Remember, the stock is trading at $1.45 today. So on a book value basis, this stock looks like it's trading, so $1.45 divided by $5.40, it's trading for about 27 cents on the dollar, right? So you're buying $1 of book value for 27 cents. Now, the market price may value the assets lower than the book value because the market may think that the assets are not as valuable today because of potash prices declining, and potential acquirers are weak too because of their potash prices are low. So in the event of a bankruptcy, maybe you can't liquidate for very much those assets. So the market may not give much credit to the assets, but still, you're able to buy $1 of book value for 25 cents, say, on the dollar, and that provides you with some sense of margin of safety because they already wrote down their assets, remember? So you can see that in here they had $1.1 billion of PP&E in September of last year, end of September last year, and then they wrote down the assets as an impairment charge because potash prices declined and they had to reevaluate the value of those assets, and they wrote them down to $520 million. And so we're looking at $5.40 of book value of equity on a written down asset basis. So you could say, okay, I mean, and when they write down the assets, they had to do some sort of appraisals and cash flow estimations. So this is a more recent measure of the value of the assets. It still may be inflated, but even if we cut this in half and say we had 250 million of, let's say we take off 250 million. So we had 410, and we just take off 250 million, and we divide that by the 75 million shares, 76 million shares, you still get $2.13 book value per share. So when the stock is trading at $1.45, or even it was recently $1, but say $1.45, you're looking at a 50% possible gain. And that's again assuming you write down 50% of this PP&E value. So there's reason to believe that this stock is trading below tangible book value and that there is some margin of safety here. Also, it looks like the leverage is overall not too high. On a book value basis, it's 25% leverage. On a market value basis, we calculated it as around 50% leverage, a net of the excess cash of 30 million. So overall, not too leveraged, and looks like it has substantial book value of equity and a margin of safety. Now let's switch to the cash flow statement. So this statement tells us about the cash coming in and out of the business each quarter. And we can see in the past years that this company, so the cash flow from operations is sort of what the business operations can make in terms of cash. So you can see in March of last year, they made about $33 million from their operations, $55 million from their operations in the June quarter, and then 44, and then it started dropping as potash prices started dropping, and then recently, I would call this break even. So remember that cash flow from operations includes interest expense. So their breaking even means that they're able to pay, through operations, they make enough money to pay all their salaries, all their costs of extracting the potash, and their interest expense and break even. Now it doesn't include capex. So they're breaking even on operating, but then they have to invest in capex to maintain their mines. It looks like the capex of 6 is quite low relative to what it could be, what you might have expected it to be. So 6 a quarter, which is 24 or 25 million a year, say, of capex. I mean, they had 55 million of cash on hand, and 30 million of that was excess cash. So if they have 25 million of capex and 30 million of excess cash, then if they can break even on their operations, they have enough cash in excess to cover their capex for at least 1 year, so give them some runway. And let's see, you can see from, where is it? Cash flow from finance. Maybe we have to look at annual. So I switched to annual mode instead of quarterly mode. So here you can see that they issued the 150 million of debt in 2013, which was relatively before the recent decline in potash prices. And since then, they haven't issued any more debt, and they haven't issued any stock either. So their share count has been fairly stable, which is nice to see. And they used to pay dividend, but they don't do that anymore because the potash prices are down and their profits are challenged. So let's go back and recap. So the stock price is low, and justifiably so. The market is going through a correction. You have excess supply. You have weak demand from farmers because crop prices have been relatively low. But you have a long-term good prospects for this. Food is going to be essential, and nitrogen and potash are going to be essential for growing more food to feed more people with limited land. Only so much land is arable. And so overall, long-term, this will be a great sector. Now, is this a good time to look at this company? Well, the CEO and chairman and 10% and 15% owner has been buying. He started buying in September, so he was buying here. And then he bought again in November, beginning of November, so he bought after this decline. And then he bought in March, and he also bought recently in May. So he was buying around here, and then he was buying around here. So the CEO and chairman thinks that this is a good deal, and these guys tend to know the business very well, and they have better information than any shareholder can or analyst can about the prospects for this company. That said, these guys are long-term investors, so if you're willing to hold for many years, then it's worth considering buying alongside them. But it also is a good idea to let the price continue down. So they say don't catch a falling knife. So if the knife is falling, let the knife fall. And he's been buying at 6 and 4 and so forth. So it's been falling despite him buying, and so the market seems to disagree with him, or there have been a series of negative developments since he's been buying that have been now included in the stock price. But nevertheless, you're able to buy it at a substantial discount to what he was buying it just a couple months ago. So I think of that as a bullish sign. The other bullish indicator here is that it's been falling for over a year now. So it started falling rapidly since June. It's really been falling for a couple years, but say rapidly since June it's been falling. And then seem to have what you might call a capitulation event here, where large volume and decline, and then ever since then it's been relatively flat. / you're starting to see somewhat of an uptrend here in the price, which we have never really seen before. So you can see downtrend, 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 downtrend. Now you have somewhat of an uptrend. And it's important because when you're buying a stock, you're really trying to think of who's going to buy it from you in the future. So you want to see some evidence that people are willing to buy this company. Over here, you don't see much willingness for people to buy this company other than the CEO, which is an important person. But you, in general, see the market selling off from this. And this could be because large funds are reducing their exposure to the potash because the fundamentals are deteriorating, and they are not allowed to sometimes take on a certain amount of risk, and so they just sell, driving the price down. And then once they're done, then they may have oversold. So this stock could move relatively quickly up to, let's get rid of these flags, could move relatively quickly up to, mid to 250 or $3 from here if the momentum could continue. So the other reason why the stock is down so much is because the debt that we talked about had covenants in it, which are agreements or restrictions that they're rules that the lenders put with their debt that protect the lenders. So because some of those covenants are that you have to release your financials at your year-end financials or the 2015 financials within a certain number of days, and they have to not have a going concern warning from the auditor. So the auditor will put in a going concern opinion if they think that the company's cash flows may not be able to meet the debt obligations, or maybe there'll be a violation of the covenant. And so they have a going concern opinion, and therefore technically they were violating this covenant, which can lead to a default. They reached an agreement with their lenders, and also they have a credit facility, which they use as somewhat of a checking account or credit card rather, and both of those. So they've reached an agreement with their lenders to ignore these covenants in the short term until June 30th and July 30th. You'll have to look into those details. But it seems like, in my opinion, these are not a big deal, because as we look at the asset value, the tangible asset value for this company on a book value basis is $5.40, which is substantially higher than the current price. And even if we cut the assets in half in terms of if you sell them and you only get half of what they're on the books for, you still have $2.50 for value. So this company's equity has a solid claim to value in this company. Unlike other companies that go bankrupt, the equity has no claim to value because the company is worth less than the debt. Here, we're worth more than the debt for sure. So I don't think that these covenant problems are going to be severe because the leverage is not very high and the equity has quite a lot of value. So I think we can rearrange the capital structure without any impairment to the equity holders. For example, we could probably issue secured debt. So the debt currently is unsecured, which means it has no claim to any of the collateral. Unless the indentures for the unsecured say we can't issue secured debt, we could issue secured debt with claims against the collateral, like our mines, and raise some new funds that way. Or we could, but that really the covenants we're worried about are profitability related. So we really just need to relax those covenants, either by reaching some sort of agreement with our lenders or find new borrowing. But overall, they should be more. So the concern was that they were not so profitable. As we saw, the cash flow from operations was not positive in the last quarter. But and potash prices are low, so you might say, well, it won't be positive for maybe ever, and maybe the business is insolvent. But they have made some major restructuring changes to this company, which you should look at if you read the transcript. So I like to read the transcripts. If you go to seekingalpha.com and then you go to Intrepid Potash and then you click on transcripts, you can see the transcripts and it's great because the Robert or Bob will tell you all about the business and what they have been doing. And what you'll see is that they have some high-cost mining facilities, which they have either shut down recently, which means that they are no longer losing money on those businesses and they're saving those assets for a time when potash prices recover. And they've also converted some of their plants a higher margin product that's less oversupplied. It's called Trio, or it's marketed as Trio, which is really really the phosphate with some magnesium in it, which is better for certain applications. And it has been sold in a how do you say? So they've always had more orders than they've been able to fill for this Trio product, and they've been able to charge a higher margin for it. And now they've rearranged some of their plants to focus on producing more Trio. So that's really their growth strategy. And they are only 2 mines, they claim, that have this magnesium phosphate or potash that can produce Trio. So it's much less oversupplied. And so they closed down some of their high-cost traditional potash manufacturing. They have now this new higher margin Trio product, and they have a new form of potash manufacturing called solar, which is much lower cost. It's about $100 per ton, $100 cost, and you sell now for like in the 200s. So you have a decent margin on the solar manufacturing, but that is more weather dependent, obviously, and so they're more now exposed to issues in weather. But overall, the company seems to be making the right choices. You have management that own 30% of the company, you have relatively low leverage, you have high book value of equity, and probably a good margin of safety here. You have a dramatic fall in the price of the stock. The managers have been buying as it fell. It seems to have maybe flattened out recently, and they're working right now with their lenders. So upcoming catalyst would be a positive resolution to these covenant issues, and they've already completed transitioning their company over to a lower cost form by closing the high cost West facility. They call it the West facility, and converting the East facility to producing Trio. And so we'll start to see the benefits of that in the back half of the year. So I think overall the prospects of this company are improving, and the cash flows from operations should be improving too. And it seems like the falling knife has stopped falling recently, and there's some uptrend in the stock price. So I would give a positive 3-month outlook for this company, and long term, I definitely think this is a great investment. But even short term, I think now is an interesting time to think about Intrepid Potash. But remember to do your own homework, and please subscribe if you found this useful. And if you want me to do a video on a certain company, please comment on it below, and I'd be happy to give my thoughts. This is just an effort so that people out there who are learning to invest can get up to speed and learn some tricks and tools and resources to analyze companies with. Okay, bye everyone.